Hello, good morning, everyone. My name's Paul Foreman, and welcome to the latest Novia Pulse webinar. With it being Halloween today, we thought we'd give you a scary topic, and scary in the sense that with the lifetime allowance and all of the changes that have happened since 2006, when first introduced, it must be a nightmare for advisors to advise clients with any long-term certainty. So I'm delighted to say that today we're joined again by our friends at QB Partners. So we have Dave White and John Clare today with us, and they'll be looking at the historical changes to the lifetime allowance, where we are today, and potentially where we will be going in the future with the lifetime allowance. As always, there'll be an opportunity to ask questions. Just click on the button at the bottom, Q&A, and we'll run through those at the end of the session. And without any further ado, I'll hand you over to David. Thank you.
Thanks, Paul. Morning, everybody. Just click onto the agenda for you. I think. There we are. Yeah, so we've got a packed agenda today, as Paul says. We've got a bit of history for you, a bit of politics for you, and a bit of myth busting at the end. So that's quite spooky as well. But we'll get on with that in a minute. Just to introduce ourselves, QB Partners. Most of you know us, I think, but we're an independent service for professional advisors and product providers. We work with Novia Global to provide them with technical support. So in respect to Novia Global, obviously Paul and his team know a thing or two themselves. So, go to them with any technical questions first. But they have then recourse to us and come to us with any more complex questions. We have a range of consultants across all areas of financial planning. John and myself on the call today are pension specialists. Mike leads the relationship with Novia Global, and Mike is an insurance specialist, but also a European specialist, which is why he's involved in the relationship with Novia Global. So you can use that relationship to answer any technical questions that you might have. And then also, when you've got clients engaged, you can use our more detailed services to provide you with suitability reports. They're all backed by RPI. We provide due diligence reports as well. So it's a full technical service that we provide. Okay, sort of promotion over. We'll get on to the subject of the day. So we're talking first of all about the history of the lifetime allowance, and important to note that the lifetime allowance was introduced by Labour on A Day, which was April 2006. And because pensions have tax relief, the government felt that there needed to be a limit on the amount of savings that could be tax relieved. And that was the annual allowance, which is obviously an annual limit of the amount that can be paid into a pension each year. And also the lifetime allowance, which is the amount can be paid over a person's life. It started off at 1.5 million, and we'll look a bit in a minute about how that's changed. And it's the maximum amount of tax relievable pension savings that the individual can contribute and can benefit from. You can contribute over and above that limit, but ultimately that's subject to the lifetime allowance charges. So the lifetime allowance charges were 25% if the surplus over the lifetime allowance is taken as an income, or 55% if it's taken as a lump sum payment. There's something called protection that was in place in various forms on A Day. There's fixed protection and individual protection, and then whenever the limits changed, you were able to apply for protection to maintain the previous limit. And this is just a quick look at how the lifetime allowance has changed over the years. So as we said, it started off with Labour at 1.5 million, gradually increased to 2012, and then gradually started to decrease until the sort of recent big surprise when it was abolished altogether. So why was it abolished? It was abolished in the budget this year. And the government's stance on it was there on the orange slide, and they felt that it should be abolished because there'd been an increase in economic inactivity. The economy slowed down since the pandemic. But as we may know, the UK's inactivity is larger than other developed economies. Our economy has slowed down more than other developed economies. And so the government felt that a strong labour market was critical to get growth going again in the UK. And as we know, the NHS is, without getting too political, falling apart. One of the concerns in the NHS is that there's a shortage of doctors, and that doctors were leaving the NHS, were retiring. And so they wanted to encourage doctors to stay within the NHS and to, if they had retired, to come back perhaps, or if they were considering retirement, to remain in employment. So one of the ways they can do that is to encourage them to build a bigger pension for themselves. But if you're going to build a bigger pension and then there's going to be tax charges levied to it, then that's a disincentive. So that's why it's been taken away, specifically for the NHS, but also to stimulate the labour market generally. So it was taken away in the budget, which became Finance Number 2 Act 2023. And initially, the lifetime allowance charge has been removed. So the lifetime allowance limit, going on to the blue slide now, remains in place until next year, but the charge itself has been abolished. So there's now no charges. That 25% and 55% charge that are referred to, those charges have been removed. So there's no charges when crystallising benefits in excess of the lifetime allowance limit, and there's no charges when transferring to cure-ups now. There's no charges on reaching age 75 as there was before, or on death. The payments that were subject to a 55% charge are now subject to income tax at the individual's marginal rate, so that is still taxed. There's some more good news though. The annual allowance has been increased to 60,000 from 40,000, and the money purchase annual allowance has been increased to 10,000 from 4,000. They perhaps haven't thought it all through, as often is the case in budgets. So the announcements were made in the budget that the lifetime allowance was going to be abolished. That was the big headline. There was a little bit of detail, but not a lot. And they basically said that they were going to make some further changes to support the removal of the lifetime allowance, to deliver on that and to ensure that the pension tax continues to function effectively. So basically, anything we've forgotten, we'll give ourselves a bit more time to think through the detail, and that's what they've done. And that comes through in the next slide. So there is now draft legislation which has been issued on the 18th of July, and that confirms that the lifetime allowance limit will be abolished, and it brings in something new, which is called the lump sum allowance. And that's used to limit tax-free cash or PCLS payments that can be made to 268,275, which is 25% of the last lifetime allowance limit of 1,073,000. So it's the lesser of the lifetime of the lump sum allowance, and 25% of the fund value is available as PCLS or tax-free cash from 6th of April 24. Those with protection in place, though, can still rely on the protection. So if you've got 1.25 as a protected amount, for example, then you can access in your lump sum allowance 25% of 1.25 million. Some further statements for 6th of April 24 are around lump sum death benefits. So they're going to be tested against a new threshold, which is the same level as the present lifetime allowance of 1,073,100 actually, and that's called the lump sum and death benefits allowance. So any payments on death, any lump sum payments on death will be tested against that. There's no tax if the lump sum is under that level, the lump sum and death benefits allowance, but any lump sums paid over that level will be taxed at probably the beneficiary's marginal rate, actually. But again, you can use protection. So individuals have until 5th of April 25, so another year after the legislation comes into place to apply for fixed protection 2016 or individual protection 2016, and that limit is 1.25 million. So that's been extended, and that again gives them a higher level of tax-free lump sum, as we said before. So if they have a pension over 1.25 million, they can have protection at 1.25 million, and that gives them a lump sum available tax-free cash of 25% of 1.25 million, or higher lump sum death benefits as well. So they could have a lump sum death benefit of 1.25 million. If they take the tax-free cash, so let's use round numbers. If they limit the lump sum limit, the lump sum and death benefit limit is 1 million, and they've taken tax-free cash of 250,000, then the lump sum on death that's tax-free is reduced accordingly. So you've got another sort of 750,000 left. So you can't have your PCLS and your full lump sum and death benefits allowance. It's sort of aggregated together.
Yeah, I think it's worth noting as well, David, before you move on, that
Thanks, John.
that the proposals for April 24 are clear with regards to lump sums, but what's not clear is the tax position on income. So on death before age 75, previously the full amount could be passed on tax-free as a lump sum, or you could elect within 2 years to have the funds designated to provide an income, and any income that is paid is also tax-free. So with the introduction of the lump sum and death benefits allowance, we know that any lump sum that exceeds the 1073 allowance or higher with protection is going to be subject to income tax at the beneficiary's marginal rate. But if it's designated to provide an income, our understanding is that the intention is that will remain tax-free, which begs the question for very large pension funds why you would opt to take the lump sum and pay income tax rather than designating it for drawdown, where in most cases you have access to flexible drawdown in any case, and any benefits that you take are tax-free.
Yeah, thanks, John. That's a good point, and I guess we're expecting that to be clarified from the 6th of April or before the 6th of April.
Yeah.
Okay, so that's where we're up to. That's what's going to happen under a Tory government. But obviously, there's a strong possibility, and these are the latest polling stats and show that the possibility is very strong of there not being a Tory government in place by the end of next year, and the general election is in December 2024, and there's a high probability, as you can see from this slide, that Labour will get in at the end of 2024, and if they do that, as I say, the general election's in December, they can make an emergency budget statement and implement any changes from that, with effect from April 2025, so very, very, very quickly. Now, as you'd expect, when we're getting closer to a general election, Labour have been pretty quiet as to any proposed tax changes that they might make, because they don't want to sort of say anything that might affect those that strong polling that they've got. But what they have said very clearly initially, the day after the budget, it came out very clearly to say that they are going to reverse that announcement that the Conservatives made to abolish the lifetime allowance, and that they would reinstate the lifetime allowance. And if you remember, this is Labour's baby. That's why I made the point at the start about Labour introducing the lifetime allowance way back in 2006. It's Labour's idea. It's Labour's baby. Labour want to limit the amount that people can save, because they feel that it's a benefit to the very wealthy to be able to save unlimited amounts into their pension, and they don't want that to happen. So you can see why it's a Labour policy, and why Labour might want to reintroduce it. And this is what Rachel Reeves said after the budget, the day after the budget. She was really sort of strong. You know, she referred to £1 billion pensions bung for the 1% wealthiest people. You know, she referred to a gilded giveaway, is what she called it. It's the wrong priority at the wrong time for the wrong people. There's, you know, the view is that there's a lot of people in financial hardship, and instead of using that money to help people with financial hardship, they've used the money to, the Tories have used the money to make things easier for the top 1%. Now, obviously, there's an argument. You know, this is the politics that I promised you. There's an argument that it was introduced, this abolishment, to help the NHS, and you know, fairly consistently, everybody wants to help the NHS. But what she said was that, or one of their spokespeople said that, was that they, I don't know where these figures come from because it actually looks quite a low amount, but it would only cost only 32 million to fix the pensions disincentives for the doctors. There is a targeted scheme in place for judges. If they had a targeted scheme in place for doctors, to encourage doctors to come back from retirement or to not retire as early, then that would only cost £32 million. Labour's been pushing Tories to fix this, but now the Conservatives have given away £1 billion, which is the estimated cost of removal of the lifetime allowance. And you know, as well as helping the doctors, they're helping all the other 1% of rich people in the UK. So again, strong terminology, a £1 billion sledgehammer to crack a nut. Some great headlines that day. £1 billion pensions bung, gilded giveaway, £1 billion sledgehammer to crack a nut. So it's fair to say that Labour don't like it, and that's why, you know, they've said they'll reinstate it. Some industry experts have said that's an easy statement to make, that, you know, it's been taken away, it's been abolished, we're going to put it back in. But it's not actually as easy as that to do it. You need to think through the implications. You need to think through the people who are affected and how you sort of put that back in place. You know, you're actually sort of taking, are you going to put retrospective legislation in place? Are you going to take something away from people? There's obviously going to be a year where people have taken benefits and not paid the lifetime allowance. What happens to those people? So these industry experts have said, you know, it's not quite as simple as you think. And actually, you may have seen an article, and there's been another one since, I think, in FT Advisor, but this article was in New Model Advisor earlier this month. And they sort of not backtracked, but were a bit more vague about it. The Labour Treasury Minister, who's got the wonderful name of Tulip, she was questioned, and she was a little bit vague and said policy decisions are yet to be made on restoring the allowance. So that could mean that we're deciding whether or not we're going to restore the allowance. More likely, it's going to be that we're deciding how we're going to restore the allowance and what the detail of that is. And again, sort of thinking that through. You know, politicians, as we know, often make these big sweeping statements without thinking through the detail, and then the poor civil servants have to sort of run around behind them and try and make it work. So that's where we think it's up to. But you know, Labour have been very sort of clear that they want to reinstate it, and that's understandable because it was their policy, and we can understand why it would be their policy. Okay, so what are the possible planning opportunities out of this? What should you be considering when talking to your clients about the lifetime allowance, and about the fact that, you know, Labour may reintroduce it? So at the moment, UK pension members who would previously have suffered the lifetime allowance can now crystallise the benefits without any lifetime allowance. But there's this sort of threat looming over us that Labour are almost certainly going to get into power, and Labour have very strongly stated that they're going to reintroduce the lifetime allowance. So that is a clear cause for concern. What we've seen advisors doing, and this was sort of proactively prompted by advisors rather than something that Keeley Partners suggested to advisors in the first instance. But a lot of advisors we're seeing are advising clients to crystallise their benefits now whilst they've got certainty over the rules. So if they crystallise the benefits now, there's no lifetime allowance charge. And obviously you can do that within a UK scheme by taking PCLS, by designating funds to draw down. So that's a straightforward way of crystallising benefits, and there'll be no lifetime allowance. So do that before Labour get into power, whilst you know what the position is going to be, and it's very clear. And then if Labour do get into power, it's very unlikely that they'd be able to retrospectively change it, so get that in place. The other way of doing it, which is another planning opportunity, is by transferring to cure-ups. And again, we haven't been talking to advisors about this in a proactive way, but advisors have been coming to us and saying, well, you know, could we transfer to cure-ups? Is that a way of planning for it? So we've said, well, if your client's over 55, you perhaps don't need to, just crystallise benefits. But if your client's under 55, then you know it is a way of planning for it. So sorry, just slides are sticking. Now they've all gone together. Sorry about that. So just a quick sort of recap of cure-ups. I'm sure most of you know what a cure-ups is, but overseas pension scheme that meets HMRC's criteria to receive UK registered pension transfers. You can only transfer from a UK registered pension to another UK registered pension or to a cure-ups. They were originally designed, as the name suggests, for people who are non-UK residents. And the main benefits now are post-retirement, and they've done a lot to bring cure-ups benefits in line with UK benefits. It's often thought one of the sort of myths is that cure-ups can't be used at all by UK residents, but they can, and HMRC have said that they can and have confirmed that they can when they introduce the overseas transfer charge by extending the exemption on the overseas transfer charge to UK residents. So cure-ups can be used by UK residents and obviously European residents without an overseas transfer charge. And you get then the same flexibility as tax treatment as UK SIPs, but also you get some lifetime allowance advantages. So if a fund could breach the lifetime allowance in the UK pension, a transfer to cure-ups is a benefit crystallisation event, benefit crystallisation event 8. And in the legislation, the draft legislation that we've referred to regarding the lifetime allowance, there has been reference to some of the benefit crystallisation events being removed, and you know they were put in place because of the lifetime allowance, but they haven't yet made reference to benefit crystallisation event 8 being removed. But even if there is a benefit crystallisation event on the transfer to cure-ups, the lifetime allowance charge is now 0. There was previously a lifetime allowance charge of 25% on transfer to cure-ups. And once the pension funds have been transferred to cure-ups, they can grow without any further assessment as to the lifetime allowance limit. So you crystallise your benefits, you transfer, you don't pay any lifetime allowance charge. The funds continue to grow and there's no lifetime allowance charge going forward. So if the lifetime allowance was reintroduced by Labour, there wouldn't be any lifetime allowance charge impacting on the cure-ups because it's not a UK pension anymore. They're not tested against the lifetime allowance charge when drawing benefits or at age 75 or at any other time. So, you know, we've said that's true for UK pensions at the moment under the Tory government. That's what's going to happen. There's been some changes with the lump sum allowance and the lump sum death benefit allowance, but generally speaking, you know, lifetime allowance charges have been removed for UK pensions. But what happens if Labour comes back in? Labour could bring the lifetime allowance back in, and you can hedge for that by either crystallising if you're age 55, taking PCLS, going into drawdown, or by considering transfer to cure-ups. So we think at the very least, and again, we haven't been sort of pushing this, but we've had advisors approach us, and we think, you know, it's a conversation that advisors should at least be having with their clients, particularly any of them who, you know, highlight themselves. What happens if Labour come in? You know, are Labour not going to sort of reintroduce the lifetime allowance? What am I going to do about that? So you've got two options there that you can talk to clients about. One if they're over 55 or, you know, approaching 55 perhaps before the end of next year, or, you know, two if they're under 55, consider this transfer to cure-ups option. There's a little case study that we've got which we'll just look at very, very quickly. This is based on the rules prior to the abolishment of the lifetime allowance. So, but I think everything in here still applies and is still sort of still would work. So we've assumed Mr. Michaels is a 50-year-old UK resident, UK domicile. He's got UK pensions totaling 950. He's secured fixed protection at 1.25. His investment manager's targeting net growth of 5%. And if he gets that 5% growth, he's going to exceed his lifetime allowance by age 55. He's intending to retire at 65, and based on 5%, the 950 that he's currently got will have grown to 1,975,000 by 65. And if there's a 25% LTA charge applied to that, that's 181,000. So we're keeping the figures simple, but 181 is 25% of the difference between the 1975 and the 1.25, which is his fixed protection limit. If he transfers to a cure-ups though, he doesn't now pay any lifetime allowance charge on transfer. He uses 76% of his lifetime allowance. He's still got 24% left. But he's now in an environment where that growth that he's got within the cure-ups isn't subject to the lifetime allowance. And there's no lifetime allowance charges applied when he takes benefits, or when he reaches age 75, or when he dies. There's no lifetime allowance charges applied at any time. So if Labour were to come back in and to say we're reintroducing the lifetime allowance, this client's in a cure-ups and it wouldn't apply to this particular client. For a UK or an EEA resident, you'd be looking at a Malta cure-ups. And Malta cure-ups have access to the same investment solutions as UK pensions generally, and they can take 25% tax-free cash from age 55. They can take flexible drawdown, so there's no sort of disadvantage. And it's, you know, we think it is something that should be considered and discussed. Cure-ups are not, there's not a significant cost difference between cure-ups and UK pensions, so it's something that should be considered. Okay, and this is just a quick graph which shows that on transfer to cure-ups, sorry, if you left the pension in the UK and didn't transfer to cure-ups, then the lifetime allowance charge, as we said, would be 181,000 at age 65. If they took benefits at age 65, obviously it's different at different ages, and if you assume a high growth rate, it increases. So when we get to the Q&A, if there's any sort of questions on that planning, please pitch in and ask us, and John will answer all the difficult questions for you. But I'll leave that for now, and we'll just go on to the last few slides, which Paul's going to sort of help us with and come back in on. And we've called this myth busting, and we wanted to be nice and dramatic because it's Halloween. This is all about a Telegraph article earlier in October, which I know a lot of you saw, and which Paul commented on, Paul Foreman. And basically all I've done here is we put some slides together which are the key points from the article, and then some of Paul's comments on it, which we very much agreed with. So these were some of the quite alarming points that were made in the article. And the first one was bank accounts will be closed and pension schemes won't pay to overseas banks. So we know that I think Barclays was the latest to say that they were going to be closing UK bank accounts for overseas residents. And some pension schemes are difficult about paying to overseas banks.
Yeah, as you say, David, as you see, pensions is a technical area, so it's hard enough for advisors to get to grips with all of the changes to the lifetime allowance and other areas of pension planning. And this article, which was in the Telegraph, but also online for GB News and the I newspaper, so quite widely, quite a potentially wide audience of expat clients out there. And we were just concerned that it was quite an opaque article. And as you say, bank accounts being closed, we're fully aware that since Brexit, a lot of UK banks have been closing bank accounts for non-UK resident clients. But saying that a pension scheme won't pay to a bank account which is not based in the UK is clearly untrue. At Novia Global, we're able to pay to a client's bank account a drawdown income, a PCLS payment anywhere in the world, as long as that bank account is clearly referenced for that individual who is the scheme member. So yeah, definitely a myth. We were very keen to bust on that one.
Yeah. Okay. No, thanks, Paul. And then what about the next one? You need to be UK resident to transfer to another UK pension scheme under HMRC rules. We know that that's not true, don't we?
Exactly. I mean, we looked at this. There's no reference at all in HMRC's rulebook stating this. And we believe that this is probably just a little bit of confusion with regards to a typical UK SIP scheme where it won't transfer. So certainly for the Novia Global pension scheme, because we're fully familiar with the international advisor space, no issues for us in taking a transfer for someone who's not a UK resident, but for some of the more domestic focused operations, possibly within their scheme rules, they may have that rule which just does not permit them to do so.
Yeah, so again, it's a differentiation between what is HMRC rules, what are regulation, and what's in the scheme rules.
Exactly.
So British expats need to be UK resident to start a new pension under HMRC rules, and this is slightly different. So the previous point was UK resident to transfer to another UK pension scheme. This is starting a new pension scheme under HMRCs. You need to be UK resident. What about somebody who's planning to move back to the UK in the next couple of years and they want to get a pension scheme started? Can they not do that?
Yeah, exactly. So as long as there's UK relevant earnings to support the contributions, again, when we reference the rules, although at Novia Global we are a transfer only UK SIP scheme, in those rules, again, nothing that we can see that would prohibit that taking place.
Yeah. So you wouldn't get tax relief on the contributions, obviously, if there's no net relevant earnings, but you are able to make contributions. Yeah. And then the last point: bereaved families are being forced to take death benefits as a lump sum. That was pretty dramatic, but again, we don't think that's true.
No, exactly. And this was an area where at Novia Global we have benefited from having this particular option. We're able to take beneficiary transfers into the UK SIP that we offer. So where a member is deceased and they have nominated beneficiaries, either a singular person or more than one, they have the option to transfer, and they could transfer that nominated pension to ourselves and take that benefit as an ongoing income. So again, more down to the scheme rules. Looking at the companies that were quoted in the article, they are very domestic focused companies and probably don't have the awareness of the international space that Novia Global obviously does.
Yeah, and that's in this last slide right here, actually, which is that there was a quote from Royal London that states the reason that cross-border pensions business isn't being offered by providers in the UK is due to risk and complexity involved for customers. And as you say, most UK providers are very focused on domestic business, and that's understandable. But Novia Global are focused on overseas business.
Yeah, and I think a great way to highlight this is prior to February of this year, when Novia Global had the change in permissions and took on the UK SIP in our own right. Prior to that, we had a joint venture with Novia Financial, and in their scheme rules, they had many restrictions on what they could do outside of the UK, which didn't apply to Novia Global. So it often is a case that the individual scheme rules may prevent a provider from offering a service, whereas for Novia Global, the clue is in the name. Our focus is on the international market space, and we wouldn't have such restrictions limiting us when it comes to international and expat clients.
Right. Okay. Thanks, Paul. Okay. Thanks everyone for listening. That's the end of the slides. You'll be glad to know. And we're now going to open up for a question and answers. So I think there's already some questions that have come through. So Mike's going to read out some of the questions for us on behalf of the audience, and then myself, John, and Paul will do our best to answer the questions for you.
Okay, yeah, we've got 3 questions so far. Obviously, anybody else now at the end of the session, if you want to fire anything up under the Q&A, please feel free to do so. The first couple are from anonymous attendees. Don't hide behind your screens. So great content. My question is, do international treaties or agreements play any role in the context of the lifetime allowance changes for expatriates? Also, what is the best way to stay informed about UK pension regulation changes from overseas?
Yeah, good question. For most part, the double tax treaties that the UK has with many different countries around the world will not impact the way that lifetime allowance is charged. Of course, with the abolishment of the charges, there shouldn't really be any impact anyway. I think the main one now is that where there is a 55%, or where there would have been a 55% charge, and there's an income tax charge, if that pension member is overseas, it may be possible to reclaim or have that income tax charge offset. Of course, if the Labour bring back the lifetime allowance as promised, then yeah, lifetime allowance charges will apply again. And yeah, the double tax agreements, the double tax treaties don't have any impact, and there's no way to reclaim it just because you're non-UK resident.
And the second part of that question was the best way to stay informed about UK pension regulation changes from overseas. Presumably, John, that's contact QB or Paul at Novia.
Yeah, subscribe to Novia's newsletters or to QB's newsletters, or both. Yeah, obviously, keep an eye on the financial press as well. Although, as we've highlighted here, this was the Telegraph article, but not everything that you read in the press is correct. So if you read something in the press that's alarming, then again, please feel free to contact us. Paul did a great job of busting these myths when this article was issued, and we were involved in that as well, and we would be happy to do the same. So that's probably the best way for the people on this call is to you've got some great support from Novia Global and from QB Partners, and we're happy to continue to support on things like that. And we keep an eye on what happens in the regulations, and aim to issue highlights on that when we can. Whenever there's budgets, we issue a budget summary. So yeah, get subscribed to the newsletters.
Yeah, I'd echo that. Keep up to date. Make sure that you're registered for these updates. And as David says, when anything of substantial nature changes, we always fact check and cross reference with the guys at QB to make sure there's a consistent message going out.
Okay, thank you. The next one is, could you, again, thanks for a very interesting presentation. Could you elaborate on what steps you think a client planning on returning to the UK in the future should take now to ensure a smooth transition and continuity in their retirement planning? Who wants to go first on that one?
Yeah, I think that each client's circumstances should be reviewed on a case-by-case basis. I think wherever you have a client that's planning to relocate in the future and there's certainty over that relocation, then it's sensible to review the structures they have in place, to review any pensions plans they have in place, and make sure that those pensions will remain appropriate, remain compatible following the relocation. And yeah, take financial advice, obtain specialist support from a service such as QB Partners. I mean, a lot of what we often see with non-UK residents is that they've transferred their funds to CureOps, and circumstances have changed. They've decided to come back to the UK, and they come back to the UK, obtain UK advice, and the UK advisor isn't familiar with CureOps, doesn't know if they're appropriate for UK residents. For most cases, CureOps can be used by UK residents, and there won't be any disadvantages. But it is possible to repatriate and bring CureOps back into the UK. So that's something that can be looked at, and that's something that we can support.
Yeah, and again, it's worth pointing out, John, isn't it, that not all the UK pension schemes will, one, as we've said, deal with non-UK residents, but also not all the UK pension schemes will accept transfers from CureOps. So again, that's where you need some, sort of specialist input sometimes. Novia Global will accept transfers from CureOps, will they, Paul?
Yeah, that's right. As long as the scheme is on the recognised list from HMRC, that's a standard transfer. And even if it's a delisted scheme that formerly had CureOps status, we can still look at those transfers subject to the usual due diligence.
Yeah. But the more sort of traditional domestic UK pensions don't like the idea of CureOps, think it's, as this slide in front of us says, think it's a high risk, and wouldn't necessarily want to accept transfers from CureOps. So you need to be sort of careful which schemes you use. Yeah.
Okay. Steve Langford's asked a real curveball. We'll come back to that in just a second. I think Steve is typing an answer to the question. Can you still getting the internet unstable message? Will you share the slides after the presentation? I think Steve is maybe coming back on that one. I'm assuming the answer is yes. Quite how you do it, I'm sure Novi will explain. Does the 25% charge for a transfer to a CureOps still exist for transfers outside the EA? John, do you want to just cover that one quickly?
Yeah, it does. For most, the overseas transfer charge applies on any transfer to CureOps where an exemption is not met. So the main exemptions to CureOps transfers are, first of all, the pension member being resident in the UK or the EEA and using an EEA or Gibraltar-based CureOps. And when we talk about EEA, generally we're talking about Malta. So using Malta and Gibraltar, being resident in the UK, being resident in the EEA, you're exempt from the overseas transfer charge. The second exemption is same country CureOps. So Australia, I think, is the best example really, where they have local pensions legislation and rules that allow transfers of UK pensions into local pension schemes. Many other jurisdictions outside of the EEA will not have local CureOps that can receive transfers. So a transfer to any other jurisdiction would incur an overseas transfer charge, that 25% tax. And the third exemption relates to occupational schemes, which, if you've got an occupational scheme, you can transfer to your new employer potentially. But for most instances, if you're outside of the EEA, what we instead look at is a UK pension scheme that's designed and able and willing to receive transfers for international non-UK residents, such as the Novia Global SIP.
Okay, thank you. Any more to add to that, guys? We'll go on to the next one. Question from Mark Quinn. Great content. When you say transfer to CureOps under age 50, why do you put this age on it?
I think it was 55. But basically we're saying that if you're over 55, which is the minimum retirement age in the UK, then you can crystallise your benefits without a lifetime allowance charge now. You can't crystallise your benefits until you're age 55. So an alternative to crystallising benefits is transferring to cure-ups. So we're not saying you can't transfer to cure-ups after 55. We're saying that there's two options. One is to crystallise benefits within the UK scheme, which we can only do after age 55. One is to transfer to cure-ups, which really you could do at any age.
Yeah. And okay. I think just to expand on that, there's really two sets of circumstances where cure-ups would be appropriate to consider. And the first one is where the client has, or where you have for the client, lifetime allowance concerns. Cure-ups could be a benefit. And the other instance is where the client is non-UK resident or plans to relocate and become non-UK resident in retirement. Those are the two sets of circumstances where cure-ups should be considered. Otherwise, we'd recommend that the funds remain in a UK scheme.
Okay, thank you. Okay, one more, and then we'll go back to Stephen Langford's question on the Spanish Inquisition. So this one is, if income remains tax-free under the allowance for beneficiaries, what happens if they transfer to an international SIP and they want to continue drawing income? Is it still tax-free?
Yes. This is when the pension member dies before age 75. There's no changes to the pension age. So if you die before age 75, the lump sums can be passed on tax-free up to the new lump sum and death benefits allowance, and any income remains tax-free as long as you make your election within 2 years of the scheme being notified of death. Then that income will remain tax-free, and the scheme can be transferred, and you can use an international SIP, an OV Global SIP, and they will, and correct me if I'm wrong, Paul, but they will be able to continue paying income tax-free.
Yeah, that's right. As long as the original member is deceased before the age of 75, the scheme that we receive would continue to pay that income out without any tax at source. Of course, as an advisor locally, you just need to be aware of what implications there are in the home tax residency country on that income stream, but certainly at source it would remain tax-free. Yep.
Yeah, and the reason that transition can be made fairly easily is that both schemes being discussed there are UK registered pension schemes. The money's coming from a UK registered pension scheme. The international SIP, despite the name, is a UK registered pension scheme. It's a UK registered pension scheme that can take transfers from non-UK residents and deals with non-UK residents, but it's still a UK registered pension scheme. So you're transferring from one UK registered pension scheme to another under the same regulatory regime.
Okay, so back to Stephen Langford's question. He congratulates on a brilliant session, and then asks, may I ask your view regarding the Spanish authorities' treatment of a transfer from a UK pension to a cure-ups while the member is already a Spanish resident? There is a wide view in Spain that they will treat the transfer as a full surrender, and the transfer, as in the full transfer amount, will be taxed at the member's marginal rate of income tax in Spain.
You want to take that question yourself, Mike?
Well, I was going to say I might sort of start off on this and then jump in. We do seem to be in a very, very strange situation currently with transfers, or pretty much anything to do with pensions in Spain. Spain, if you remember, is a civil law jurisdiction. Usually that means that laws are created and agreed by the government, the legislature, and they're set down in the law book, effectively. That's how a civil law jurisdiction generally operates. Common law jurisdictions such as the UK, that's where we have those sort of written down laws, but then an awful lot of laws are evolved through case law. So actual cases that go through the courts, get a result, get a view, an opinion, and that marginally evolves and changes the law as we go along. What we've now got happening in Spain is that because of a private ruling that was taken, I think it was either 2021 or maybe early 2022, and it was a transfer from a Jersey pension scheme to, or intended transfer from a Jersey pension scheme to Curops in Malta, I believe. And they went and asked their local tax authority in Spain whether that was going to be okay. And quite surprisingly and unexpectedly, the authorities gave them a very low amount, which I'm talking less than probably 20 or 30,000, as a tax-free amount. And the whole of the rest of the scheme that they were transferring, they were going to tax at the marginal rates. Now, that private ruling seems to have triggered a kind of wave effect that is now, if you go and ask, and we do this quite regularly as QB partners, you go and ask a tax advisor in Spain right now to give, their view on something like this. A client's already in Spain, do they transfer from their whatever pension they've got in the UK? Do they move it to an international SIP? Do they move it to Curops? Where should the Curops be? Most Spanish tax advisors will not give a view on this. And what they're turning around and saying is that you have to go and get a private ruling, which, unless I'm misunderstanding something, is moving a civil law jurisdiction towards a common law outcome. And that's extremely unexpected and extremely unhelpful. So unfortunately, at the moment, I don't think anybody has got a very, very clear answer on this. I have seen and spoken to some advisors in Spain, tax advisors, that believe that what they've done historically is simply change the designation. So gradually on the tax returns or the 720 or whatever it may be, you begin to just marginally change the information that you're reporting back to the Spanish authorities. We've seen situations where clients are already taking effectively a drawdown from their SIP. The problem with that is that those UK SIP providers, if it's not somebody like Novia that's an international SIP, those UK SIP providers then won't engage with an EU-cited financial advisor because you're not FCA regulated. If you try and transfer it then to a Curops, do you then incur this massive tax penalty on the client? Is it possible to maybe move it to an international SIP with somebody like Novia? Does that get around the problem? Because it's UK to UK transfer effectively. It is a problem. And I don't know, Paul, you're obviously experiencing some of this as well. You're getting a lot of queries. We talk about this on a pretty much a bi-weekly basis.
Yeah, I had a right smile when I heard the question because, as you know, we've exchanged quite a few communications on this over the past few months. I think a rather large firm based in Spain has triggered a lot of this with some articles and online and radio messages too. All I can say is that we're still conducting transfers in Spain and we're yet to hear of anyone who has reported back of any tax complications. So it is business as usual as far as we're concerned. And as we mentioned earlier on, if the landscape does change and we become aware of anything, we would certainly bring it to a wider audience by way of a forum like this, because we could probably do a whole session like today on Spanish residents and pension transfers or via our regular newsletter. So watch this space, but at the moment it is business as usual.
Yeah.
I would... Yeah, sorry, John. I just want to say I would agree with your comment there, Paul. That we are clearly aware as QB partners of many transfers that have gone on from one type of pension to another, whether that be UK SIP or DB scheme into an international SIP or Curops, and these transfers have been going on for many years, and we're not really aware, other than that specific Jersey to Malta Curops, that there has been an actual, problem that somebody has that they found themselves in. We've dealt with a few cases in the last few months where clients are already taking their drawdown from these different contracts, and they're reporting all the time to the Spanish tax authorities, and it doesn't seem to be getting, a red flag. So it is a strange situation. There is no doubt about it. There is a grey area there right now. And I think for me, it's about making sure that any advice you give mentions this and obviously flags it as potentially an issue. But, if you think about it from the Spanish position, it's a very strange thing to start discouraging people who've saved all of their lives to be able to fund their retirement and not become a burden on the state, having moved to Spain. It doesn't really make any sense just to go and land grab a little bit of tax and create an environment of fear and disinformation. It's a very strange one to me. And I'm not aware of any other country that we're running into these sort of questions and issues with. It's certainly not happening in France, Portugal, or elsewhere. So it does seem a very peculiar one, and quite how we get to the bottom of it and get further clarity on it and get rid of the ambiguity is a bit of a question for all of us right now. Sorry, John, you were going to...
Yeah, no, I'm conscious that we're spending a lot of time talking about Spain in particular, but I think it's just worth stressing that for, most jurisdictions, EU, non-EU, the actual process of transferring a pension into another pension scheme, another recognised regulated pension scheme, is not a taxable event. It may not even be a reportable event. So in most instances, there should be no reason to trigger any tax charge, any tax liability on transfer of a pension. Of course, we've seen this issue crop up with Spain with one firm's opinion. But yeah, in most cases, it's not going to be an issue. And it's only at the point that the client accesses the benefits, once they draw benefits, once they receive an income, that will become taxable.
Okay.
Yeah.
All right, let me just check. Oh, we may have a couple of additional questions creep in. Okay. This is from Malcolm McDowell. If a client is over 55 and wants to continue to grow his pension, then crystallizing in UK does not make sense. He should do a cure-ups.
Yeah. I think we've spoke about the two options really for clients that are concerned with the lifetime allowance, and basically the two options are crystallize the fund in the UK or transfer to cure-ups. With transfer into cure-ups, you retain that tax-free cash pension commencement lump sum. If there's any investment growth and the lifetime allowance is reinstated, that's protected under cure-ups. So there are some additional merits for using cure-ups over UK pension purely for lifetime allowance purposes. Although again, this is hypothetical, and we don't exactly know when the lifetime allowance will come back, how it will be reintroduced, if it will be reintroduced. But for individuals that, if we look at a client that has for round numbers 2 million in UK pension, that they're at retirement age, they were looking to crystallize the benefits, access the tax-free cash, transfer to cure-ups, whatever, last year, they would have been paying a lifetime allowance charge of around 250,000 on transfer to cure-ups, or up to 55% to 550,000, assuming roughly 1 million lifetime allowance last year. So they can look at the situation now, and they're much better off on accessing the benefits, on transferring to cure-ups. So it's great news for those clients, but the Labour promise, the Labour threat of the reintroduction is obviously a cause for concern, and we can address that concern, I think, pretty comfortably by crystallising the benefits. And yeah, as I said, there are some additional merits of using cure-ups where lifetime allowances are concerned, and also cure-ups should be considered if the client does intend to retire outside of the UK. That's primarily what they're designed for.
Thanks, John. So Stephen has come back and said absolutely fantastic response. Exactly what we've been going through and discussing with clients. So yeah, And anyone else with that issue, do feel free to reach out to Novia Global and or QB. And we did have a question earlier from Philip Legrand. Will you share the slides after the presentation? So Steve Newell of Novia Global has gone back and said, yes, a copy of the slides will be shared later today. So you've got your answer to that one. No other questions, so I'll hand back to Paul to see us out.
Thanks for that, Mike. Just one final question. I've had a text from Eddie in France saying that there's been a lot of talk of QROPs. Does that mean that Novia Global will be offering a QROP solution in the future? Just to clarify, in terms of wrappers on the platform, we offer a GIA, we offer a UK SIP, and we will shortly, with a sneak preview, be launching an ISA wrapper too. But as part of the GIA option, you have the option to open a trust GIA, and that can sit inside third-party pension schemes like a ROPS. Whether it be Gibraltar, Malta, we've got close relationship with all of the pension trustees over in those jurisdictions. So you can simply stick the Novia platform as the investment solution inside a ROP scheme if that's going to be your suitability report for the client as the method of pension vehicle going forward. So that's why we've also focused on ROPs today. Although we don't offer a ROP solution ourselves, we work very closely, and a large proportion of our business would be platform inside third-party pension scheme offered by a ROPS trustee. So just leaves me to confirm, yes, the slides will be available within 48 hours. So whether you want to go back and analyse a particular section and look at it in more detail, you can do so at your leisure via the recording, or even if you want to share it with any of your colleagues who you think might get value from today's session as well, please feel free to share that with them. Big thank you to the guys today. Been a very wide-ranging set of questions from the audience. I think that illustrates the technical aspect of what we've been looking at today, and the guys are available for follow-up questions as ourselves at Novia Global will be via your usual international sales manager. So just leaves me to say thank you for joining us today, and keep an eye out in your inbox for an invite to the next session, which will be in a few weeks' time. So many thanks today for your time, and goodbye.
Thank you.